Before we begin this video is a little experiment from my side. I've tried something different this time, and honestly, I'm not sure yet how effectively this new approach will help you understand the content. I've prepared two different approaches. Video 1, Practical Solving. A practical step-by-step approach where we focus mainly on how to solve the problems. Video 2, Explainer, a pure explanation-based approach, similar to our previous videos, focusing more on understanding the concepts clearly. From the feedback I've received so far, I know that many of you find the explainer-style videos easy to understand. But this practical solving approach is something I'm trying experimentally. So, I genuinely don't know yet how well it will work for you or how clearly you'll be able to understand the content through this method. That's why your feedback is really important this time. After watching both videos, let me know in the comments. Which approach helped you understand better? Practical solving or explainer? Also, if you have any suggestions, difficulties, or ideas about how I can improve the videos, feel free to share them in the comments. This is an experiment, and your feedback will help me understand what works best for you and decide how I should approach future videos. So, watch both, and tell me honestly what you think.
Hey everyone, and welcome to today's Explainer. I'm absolutely thrilled you're here because today we're taking something that usually looks like just a chaotic wall of numbers, and we're going to turn it into a beautiful, highly logical structure. Think of financial statements as the ultimate architectural blueprint for non-corporate entities. If you really want to understand the foundation, the health, and the daily operations of a business, you've got to know exactly how to read its blueprint. So let's jump right in. Okay, here's a quick look at our syllabus for today. We'll be covering the accounting blueprint, rules of classification, building the balance sheet, the statement of profit and loss, and we'll wrap up with crucial account notes. Section 1, the accounting blueprint, organizing the financial house. You know, without standard formats, accounting would be total chaos. It'd be like trying to build a house with doors on the ceiling. Standard formats organize raw data so we know exactly what goes where. Now, our two main blueprints are the balance sheet and the statement of profit and loss. And as we go through this explainer, I want you to look at these not as just boring lists you have to memorize for an exam, but as really logical, interconnected structures. The balance sheet, that's your foundation. It shows exactly what the entity owns and owes at one specific frozen moment in time. Meanwhile, the statement of profit and loss captures the daily operations. It shows the dynamic, ongoing flow of income and expenses over a whole period. Section 2, rules of classification, sorting the buckets. All right, before we can actually put anything onto our balance sheet, we have to know exactly which bucket it belongs in. And to do that, you've got to understand this golden rule, the normal operating cycle. The guidelines define this as the time between acquiring assets for processing and actually realizing them in cash or cash equivalents. Basically, think about it like this. How long does it take you to buy raw materials, turn them into finished goods, sell those goods, and actually collect the cash? Now, here is a massive exam tip. If a business cannot clearly identify this cycle, the rules mandate that you simply assume it's 12 months. For example, if a problem gives you an asset that takes 15 months to realize but totally fails to state the operating cycle, you have to use that default 12-month rule and classify it as non-current. This is your primary sorting mechanism, guys. Don't forget it. Now, take a look at the binary nature of this rule. Look at the criteria for a current asset. To be current, it has to be expected to be realized or consumed in the normal operating cycle, held primarily for trading, expected to be realized within 12 months, or just be cash or a cash equivalent. If an asset ticks even one of those boxes, boom, it's current. But here is the beautiful simplicity of this format. What exactly is a non-current asset? Well, it's just all other assets. Anything that fails that strict current test automatically drops right into the non-current bucket. It's really that simple. And the exact same logic applies to liabilities, but there's a very rigid regulatory test here that I really want to highlight. An item is a current liability if the entity does not have an unconditional right to defer settlement for at least 12 months after the reporting date. Read that carefully. If you owe money and you literally cannot unconditionally push that payment off for at least a year, it is a current liability. It's going to require near-term resources, and your blueprint has to reflect that urgency. Okay, before we leave these classification rules, let's quickly lock in two standard accounting terms to make sure our terminology is absolutely rock solid for problem solving. Trade receivables are amounts due to you specifically on account of goods sold or services rendered in the normal course of business. Trade payables are the exact opposite, amounts you owe for goods purchased or services received in that normal course. Let's look at a practical example. Say a problem states you owe $5,000 for purchasing raw materials on credit. That's a trade payable. But if you owe $5,000 because you bought a delivery truck on a loan, that is not a trade payable. Precision here really matters.
Section 3, Building the Balance Sheet, Constructing the Foundation.
Now that we know how to sort our items, let's step into the very first room of our structural blueprint. This is the top-down hierarchy of the balance sheet for non-corporate entities. Notice the totally clear vertical format here. At the top, under Roman numeral 1, we've got owner's funds and liabilities. This represents the source of the entity's money. It gets broken down strictly into owner's funds, then non-current liabilities, and finally current liabilities. Then, right below that, under Roman numeral 2, we have the assets. This is the application of those funds. These are split simply into non-current assets and current assets. It's just a perfect, logical flow of funding moving right into resources. Let's zoom in on those non-current assets for a second. The format actually demands specific categorization for property, plant, and equipment. You can't just write fixed assets on your paper and call it a day. No, you must break it down into categories like land, buildings, plant and equipment, furniture and fixtures, vehicles, and office equipment. And hey, remember, when you're solving a practical problem, these amounts have to be recorded net of accumulated depreciation. Keep your working notes clean. They sit firmly in the non-current asset bucket because they are long-term resources, definitely not intended for sale in the normal operating cycle. And honestly, this next part brilliantly illustrates the depth of standard formatting. Look at how specifically the guidelines force entities to categorize their invisible, intangible assets. We aren't just lumping them together into one vague, meaningless number. The format requires you to pull out goodwill, brands, copyrights, and even recipes, formula, and models. This level of transparency is exactly what makes the blueprint so incredibly valuable to anyone reading it. Moving down to current assets, let's talk about inventories. Just like property, inventory must be strictly itemized. We're talking raw materials, work in progress, finished goods, stock and trade, stores and spares, and loose tools. Now listen up, because here's a super common exam mistake. Putting loose tools under plant and equipment. Do not do it. Loose tools fall strictly into the current assets inventory bucket because they're expected to be consumed or realized within the normal operating cycle. Section 4, Statement of Profit and Loss, Tracking the Daily Operations. All right, we are moving from the static, frozen-in-time balance sheet to the highly dynamic, moving picture of the entity's financial performance. The statement of profit and loss follows a very strict, sequential mathematical flow. Here is exactly how you solve it. Step 1, start at the top by calculating total income. That's revenue from operations plus other income. Step 2, deduct your total expenses. Step 3 brings you to the profit before tax. Step 4, deduct the tax expense. And finally, step 5 gives you the ultimate bottom line profit for the period. It shows exactly how that final figure is achieved step by step. So say you're given $100,000 in total income minus $60,000 in total expenses. Your pre-tax profit is $40,000. Deduct a $10,000 tax expense and boom, your bottom line net profit is $30,000. It's a clean, logical flow. Now, within those expenses, I really want to highlight the finance costs breakdown because this contains a totally crucial classification point. The format requires breaking finance costs down into standard interest expense, other borrowing costs, and foreign currency net losses. But take a close look at that second bullet, interest on partners or members' capital. The format explicitly directs this to be classified right here under finance costs. It is a very specific requirement for non-corporate entities, so please do not overlook it when you're classifying items. Section 5, Crucial Account Notes, the fine print. So the really crucial point here is this. The face of the balance sheet and P&L, that's only half the story. The numbers on the front are just summaries. In the notes, every single movement must be explicitly calculated. Think of it as a mathematical formula you have to show in your working notes. Take the opening balance, add capital introduced, add remuneration and interest for the year, subtract withdrawals, adjust for their specific share of profit or loss, and that will equal your closing balance. This working note is a complete mathematical reconciliation, and guys, it is completely mandatory for your final answer. These notes also serve a critical regulatory and protective function. Check out the disclosures required for trade payables regarding micro, small, and medium enterprises, or MSMEs. The format strictly forces non-corporate entities to disclose if they are delaying payments to these smaller suppliers. You literally have to reveal the principal unpaid, the interest paid for delayed payments, the interest accrued at year-end, and even further interest due in succeeding years. The blueprint is specifically designed to enforce real accountability. So as we wrap up our guided tour of these formatting blueprints, I want to leave you with this question to audit your own understanding. When you construct or review financial blueprints, do they accurately reflect the strict 12-month rule and the vital nuances of your specific normal operating cycle? Because as we've clearly seen today, if you get the classification wrong at the start, the entire house is built on a faulty foundation. Thank you so much for joining me on this deep dive. Keep learning, keep your notes organized, and I'll catch you in the next explainer.
Welcome, everyone. I am absolutely thrilled to be diving into this explainer with you today, so let's just get right into it. If you've ever stared at a company's financial statements and felt like you were trying to read an ancient lost language, trust me, you are definitely not alone. But here's the real secret. These dense, heavily regulated formats, they aren't just arbitrary lists of numbers designed to give you a headache, they're actually the literal, living anatomy of a real-world business. Today, we're decoding the exact prescribed financial statement formats specifically for non-corporate entities. You know, things like partnerships, sole proprietorships, and LLPs. We're going to break down the underlying logic, so instead of just blindly memorizing line items, you'll genuinely understand how a business breathes on paper. Okay, so here's our agenda for today's explainer. We'll start with the financial statement roadmap, then move into current versus non-current rules. After that, we'll go inside the balance sheet, do a profit and loss breakdown, dive into crucial notes and disclosures, and finally, wrap it all up with a final exam recap.
Section 1. The Financial Statement Roadmap. The Big Picture of Business Reporting.
To really wrap our heads around this roadmap, I want you to think of the balance sheet as a high-definition snapshot. It's a selfie of the business taken on one specific date, showing exactly what it owns and owes at that exact millisecond. Now, the official prescribed format is incredibly rigid. Right at the top, it demands we start with owner's funds and liabilities. You absolutely cannot just list things wherever you feel like it. It follows a highly logical flow, starting with the owner's fund, which includes the capital account, then moving down through non-current liabilities, current liabilities, and eventually balancing all of that against the assets at the bottom. The whole point of this strict structure? Total transparency for anyone analyzing the health of the business.
Section 2. Current versus non-current rules. The most critical exam distinction.
Right, so before we even look at specific assets, we have to talk about classification. This is hands down the most important rule of the game. It dictates exactly where every single item lives. Get this wrong and your entire financial anatomy is completely out of joint. The rules give us strict criteria. An asset reliability is classified as current if it meets very specific short-term conditions. Anything else, automatically non-current, which just means long-term. To make this literally unforgettable for your exams, I want you to use this simple memory trick. COTS. That's COTS. C is for cash or cash equivalent. O is for operating cycle, meaning it's expected to be realized or settled within the normal cycle. T is for traded, held primarily for trading purposes. And S is for settled, due to be realized or settled within 12 months. If it hits any of those four criteria, boom, it's current.
Let's actually drill down into that O from our COTS acronym for a second. What exactly is an operating cycle? Well, it's defined perfectly as the time between acquiring assets for processing and realizing them back into cash. Think of a furniture maker buying raw wood, building a table, and eventually getting cash from a customer. That entire time frame, that is the cycle. But listen closely, because here is a massive trap examiners love to use. What if a business's normal operating cycle simply cannot be identified? The legal rule states you must assume it has a duration of exactly 12 months. Do not forget that default assumption.
Section 3. Inside the balance sheet. Categorizing the micro details. Now that we've got the overarching rules down, let's look at how we categorize the micro details. We don't just throw all the business's assets into a blender, we separate them into distinct, logical buckets. First, we have property, plant, and equipment. This is the tangible, physical backbone, things like land, buildings, and vehicles. Then we have intangibles, which hold the invisible value, like goodwill, brand names, and software. Next up is inventories, which is your operating stock. And notice how inventory is broken down even further into raw materials, work in progress, and finished goods. This level of detail tells a complete, compelling story about exactly where the business's cash is tied up.
Just as assets are carefully grouped, the business's obligations are too. Under liabilities and funds, we start at the top with owner's funds, mapping out both capital and reserves. Then we list our borrowings and provisions. But here is a really crucial detail. There's a strict requirement for borrowings. Whether they are long-term or short-term, borrowings absolutely must be subclassified as either secured or unsecured. Plus, the specific nature of that security has to be stated. Why? Because lenders and regulators want to know exactly who is standing in the front of the line to get paid if the business unfortunately goes under.
Section 4. Profit and Loss Breakdown. The video of the year's performance.
So, shifting gears from the balance sheet's static snapshot, the profit and loss statement is more like a dynamic vlog. It's a continuous recording of the business's performance over a specific period of time. The prescribed format reads exactly like a waterfall. It cascades down from top-line revenue, which is all the money flowing in, and layer by layer, it strips away different types of costs and expenses until you are finally left with the ultimate profit or loss sitting pretty right at the very bottom.
Let's look at how this builds a really simple, undeniable formula. Step 1, you start with revenue from operations, your core sales. Step 2, add in other income, like a bit of interest or dividend income. That naturally brings you to Step 3, total income. Then, Step 4, you deduct all your expenses. And finally, Step 5, you arrive at your profit. If you can just visualize these 5 steps, calculating the P&L on an exam will honestly become second nature.
Under that big expenses umbrella from Step 4, the format requires some very specific categorizations. You have to break out the cost of material consumed, purchases of stock in trade, employee benefits like salaries, depreciation, and finance costs. But wait, here is a critical detail. Finance cost obviously includes interest expense, but the rules specifically state it excludes interest on partners' or members' capital. That actually goes into a completely separate line item. Write that down because it's a classic spot where people get tripped up.
Section 5. Crucial Notes and Disclosures. The fine print where marks are won.
A lot of people think the notes to accounts are just, boring extra reading. Completely wrong. This is where the deep, meaningful transparency happens, and for you exam candidates out there, this is exactly where examiners love to set their traps. For instance, the regulations around reserves and surplus explicitly state that a debit balance from the P&L, meaning a loss, a negative surplus, shall be shown as a negative figure under undistributed surplus. This is a huge trap. When you have a negative balance, you do not magically move it over to the asset side of the balance sheet. You must keep it in reserves and surplus as a negative number, even if it makes the whole category total negative.
Now, here is a really fascinating question. What happens if a business delays a payment to a small enterprise? You might assume it just blends into standard payables, right? Not at all. The regulatory framework we're studying mandates intense, unavoidable transparency around this to protect smaller suppliers.
The MSME, that stands for Micro, Small, and Medium Enterprises, disclosure rules are incredibly strict. If a business owes money to these small suppliers, they absolutely cannot hide it. The notes must separately disclose the principal amount remaining unpaid, the exact interest due on that unpaid principal, any interest they've already had to pay because of delays, and the accrued interest remaining unpaid at year-end. It essentially forces larger businesses to be completely transparent about how they're treating their smaller vendors.
And speaking of who owes who, here's another specific timeline trap, this time for trade receivables, which is the money customers owe the business. You can't just lump all that owed money into one massive number. If a receivable has been outstanding for a period exceeding 6 months from its actual due date, it must be stated separately in the notes. It's basically a giant red flag telling the reader, hey, this money is getting pretty old and there is a real risk we might never actually collect it.
The notes also require full life cycles for assets, which we call asset reconciliations, and this applies to both property, plant, and equipment and intangibles. You have to show the gross and net carrying amounts at the start and end of the year. You have to list all additions, disposals, and impairment losses. But definitely pay attention to the revaluation rule here. You only have to disclose the amount of change due to revaluation if that change is 10% or more in the aggregate of the net carrying value for that specific class of assets.
Finally, rounding out our disclosures, we have contingent liabilities. These are potential future obligations that haven't actually materialized yet. So because they aren't guaranteed, they aren't provided for on the main balance sheet, but users absolutely still need to know they exist. They have to be classified into 3 buckets: claims against the entity not acknowledged as debt, guarantees given by the entity, and any other money the entity might become contingently liable for. It's all about making sure there are 0 surprises for whoever is reading the financials.
Section 6, Final Exam Recap. Locking in the anatomy.
Okay, let's lock this entire anatomical framework firmly into your memory. Here is your ultimate rapid-fire checklist from today's explainer. First, always remember COTS: cash, operating cycle, traded, settled within 12 months. Use that to perfectly classify current versus non-current. Second, if the operating cycle is totally unknown, legally assume it is exactly 12 months. Third, a negative surplus loss stays in reserves and surplus as a negative. Never, ever move it to assets. Fourth, always separate trade receivables older than 6 months from their due date. And fifth, remember the intense transparency required for MSME unpaid principal and interest.
I'm going to leave you with one final challenge to think about. Next time you look at an asset expected to turn into cash in, let's say, 15 months, will you instantly assume it's non-current just because it's over a year? Or will you remember to check the business's operating cycle first? Because if their cycle happens to be 18 months, that asset is actually still current. Understanding the anatomy of these financial statements means you aren't just memorizing rules. You are truly decoding the business. Thank you so much for joining me on this explainer. I hope this cleared things up, and I really can't wait to dive into our next topic with you. Stay curious and keep learning.